Hello hunters and welcome to my channel. This is Trust Veils where we move in depths of the charts. Make sure you watch until the end and don't forget to take notes and subscribe to my channel to be always updated about BTC's next move. Now let's get back in game. Breakouts and fakeouts, where the price of an asset moves beyond a key level of support or resistance, signaling a potential continuation of the trend. It happens when the price breaks out from a range it's been stuck in for a while. Traders look for these breakouts as opportunities to enter trades in new trends direction. However, not every breakout leads to a lasting move. This is where fakeouts come in. A fakeout occurs when the price seems to break out but quickly reverses back into the previous range. This can trap traders who entered early, thinking a new trend had begun. Fakeouts often happen in volatile markets or when there's insufficient momentum to push the price further after the initial breakout. We all know these breaks are important and knowing where to trust them and follow their structure is vital. In this video, we will see when we can trust them without hesitation. First of all, shadows. Not always helpful, but the easiest way is to pay attention to the shadows of the target candle in multiple time frames. When a bullish or bearish candle moves fast and passes our key zone but suddenly moves backward and leaves a great shadow, it might be a fakeout. Make sure to analyze the candle in multiple time frames to avoid mistake and let the candle close completely before entering the trade. After seeing that the break is real and no sharp shadow has been made, then you can look for a confirmation candle and enter safely. Next, supply and demand zones. Supply zones and demand zones are critical areas on the chart where strong buying or selling activity has taken place. These zones represent levels where the market historically turned, leading to strong reversals or continued momentum. Tip: zones that have not yet been tested are more important. The key idea is that large orders were executed in these areas, so traders tended to watch them closely. When the price approaches these zones, a breakout that breaches the not tested supply or demand zone is often a strong signal that the price will continue in that direction. After the break in these zones, you can look for either a pullback or a continuous trend, according to EMA, which we will discuss in this video later. Third, block orders. Block orders represent large trades that can create significant price movements. These are usually hidden from the retail market but can be inferred through price action and volume analysis. When block orders occur, whether they are bullish moves or bearish, you should follow the structure as samples in this video. The last bullish or bearish candles and their next reversal candle specify the block order, so you should compare these candles and notice which is stronger. Mostly it is clear that the smaller one's body and shadow is our block order base. Block orders often cause sharp moves in price, leading to breakouts. However, these breakouts are more reliable if they align with other factors, such as key technical indicators or in some cases supply and demand zones. Traders watch for these large moves to confirm that the breakout is safe so they can trust the process. Next is FVG. Fair value gaps occur when there is an imbalance between buyers and sellers, causing the price to move rapidly in one direction. This creates gaps in the market that are often filled later as the price seeks equilibrium. FVGs are significant because they represent areas where the price is likely to return before continuing its move. When a breakout happens near an FVG, traders will watch to see if the price returns to fill the gap. If it doesn't, it could signify a strong trend continuation, making the breakout more reliable. Or sometimes breakout happens in the direction of an FVG, and you see the tendency to continue filling it. We can recognize FVGs by seeing a stronger candle than other ones in that period and session. FVG zones starts with the close of the previous candle and ends with the start of the next candle. At last, exponential moving average EMA. The greatest feature of my strategy is EMA 200, one of the most commonly used moving averages and serves as a long-term trend indicator. The yellow line represents smooth price action and provides a clear indication of the overall market direction. When the price breaks above or below the EMA 200, it often signifies a shift in market sentiment. A breakout that occurs in alignment with the EMA 200 tends to be more reliable, especially if it is supported by volume and other factors like supply zones, demand zones, or block orders. But recognizing divergence via EMA 200 after breakout and diagnosing the reverse action between the trend line and EMA 200 shows the strong potential of breakouts or fakeouts. I've discussed extra information about these features in my first video, Having Explanation. Thank you for watching, and I hope this content helps you hunt better in charts. Please subscribe and comment if you came up with anything special. Goodbye and have great trades.